Hello and welcome to CMS Forex Daily Video Recap. I'm your Fundamental Market Analyst, Nick Nassad. Today is Friday, July 2nd, 2010. Let's start with today's main story, which was the fundamental release from the U.S., the non-farm payroll report for the month of June. In it, it showed that the U.S. economy shed 125,000 jobs for the month, but that was primarily driven by temporary jobs, as 225,000 workers that were hired for the 2010 census finished their assignments. Looking at private sector employment, there were 83,000 jobs created, which was lower than the 110,000 that were expected coming into the week, though it's better than what we saw midweek from the ADP employment change, which had a much smaller 16,000 increase. The unemployment rate, which is conducted using a different survey, the household survey, edged down to 9.5% in June from 9.7% the previous month. Expectations had been for a rise in unemployment rate. The explanation here is that more people dropped out of the labor force, which made the pool of total workers compared to those that are unemployed smaller, as the civilian labor force shrank by 652,000. Looking at a breakdown of the various sectors, and I hope this isn't too small, but we see that construction had another rough month, declining by 22,000 following a 30,000 decrease in May. Now that should be no surprise considering the weakness in housing starts and the slump in the housing sector following the expiration of the government's housing credit. Now private sector growth, as I mentioned, did increase by 83,000, and most of that came from the professional and business services, education and health, as well as leisure and hospitality. Professional business services rose by 46,000, with 20,500 of that coming from temp help. Education and health rose by 22,000, primarily led by healthcare. And leisure and hospitality, following a very weak month in May, probably a result of the oil spill and weaker job growth in the Gulf area, was up 37,000. Now the big number, of course, was the big drop in government jobs following the big increase in government jobs in May. Now, U.S. stocks have been hard hit this week, and we ended the second quarter with a thud and started the third on a weak note, as other indicators of economic activity, including manufacturing data and pending home sales, fueled concerns about the sustainability of the U.S. recovery and put a damper on overall outlook for global growth. But the non-farm payroll report, as it was not a slam dunk in terms of being a very negative report, did not plunge U.S. stocks on the news, though investors and traders did not celebrate the result either. Therefore, while we saw some increase in volatility in, say, the US dollar-Japanese yen pair, overall there wasn't much in the way of overall direction following the non-farm payroll report, except maybe in the euro-dollar pair, which rose higher to the 1.2610 area, where it found some resistance. That extended the rally we saw yesterday, which was a tall order considering the very large increase we had already seen in yesterday's session. Zooming the pair out a little bit, we see that the pair retested an important level here at the 1.2460 level, though not exactly reaching that area, finding support and then rallying, so that kept it above this important level. Now, as we went into late New York trading, we did see the pair give up some of its earlier gains as European traders closed up shop for the week. Now, we had some positive developments in the Eurozone financial sector, which helped the euro to rally throughout the week, such as a good Spanish auction, which alleviated fears of another sovereign debt crisis where a government finds it difficult to find funding. And by all accounts, the payback of the ECB's one-year refi operations yesterday went off okay. However, the broader issue here is the weak U.S. data we saw yesterday, showing a retrenching housing market, a loose labor market, and growth in manufacturing in the U.S. slowing. Therefore, the U.S. economy is looking weaker fundamentally, and that is hurting the U.S. dollar. That can break the trend we have seen of the dollar gaining on weak fundamentals news, since now the main weak news is coming from the U.S. itself. Now, that's not to say that the euro didn't end the week with strength of its own, and that this was all driven by dollar weakness. Looking at the euro-pound pair, for instance, we see that the euro extended its gains here that we saw earlier in the week, after having fallen to begin the week and to end last week. So it'll be important to see if the euro can continue to extend its gains coming back from the weekend, or if this is just a correction to this downswing we had seen as the pound had been strong following the release of its emergency budget 2 weeks ago. The euro also managed to pair some of its earlier losses in the week against the Swiss franc, as it had 2 sessions of gains now and tested the 200 period moving average in the euro franc pair on the 1-hour time frame. Now we do have this important level of resistance at 1.3460, and so far we have not been able to test it. So the main question then is, will this run of euro strength continue? And we'll see when we come back next week. Turning to the dollar-yen pair now, we saw that the pair found some support yesterday at around the 87 level. Today we saw the pair slide again in overnight trading and in New York trading, and we saw this increase in volatility as a result of the non-farm payroll report. But we pretty much ended up close to where we were before the non-farm payroll release, around this 87.60 level. Now today's action did stay within the range we had seen in yesterday's trading, and we found resistance at 88.20, which had been our support prior to Thursday. So this is a strong sign for the Japanese yen, but at these very low levels, around the 87 level, we'll see if we hear some increased chatter about Bank of Japan intervention, either direct or indirect, and as a strong yen hurts the Japanese export sector. It wasn't all downhill for the greenback. If we look at the US dollar Canadian dollar with the theme of weaker global growth strong to end the week, the US dollar Canadian dollar moved in favor of the greenback, retesting its high from yesterday around 1.0670. US stocks were down around 1% in the middle of the day in New York, and that pressured risk appetite in North America, and oil was off 1.4% to fall below $72 a barrel, which also hurt the Canadian dollar. We see that overnight we had tested this 1.0550 level, which had acted as resistance earlier in the week, but now having broken that level, we have now tested it as support. The US economy has a very large influence on the Canadian economy, as it is its main trading partner, and if the US recovery is slower than expected and the growth in the second half of the year in the US will be weaker than anticipated, then that pressures the Canadian dollar, especially since the Bank of Canada governor had said that if the US economy weakens, then that might slow down the pace of interest rate increases from Canada. So we have seen the Canadian dollar weakening versus the greenback throughout the last 2 weeks, and we had an extension of that in today's trading. The Australian dollar, meanwhile, rallied slightly overnight on the news that the new Prime Minister scaled back a proposed tax on mining companies in order to win their support and ease concerns that economic growth was slow. However, the negative outlook for global growth pressured the pair later in the day, especially in late New York trading, and it set new daily lows around the 0.84 level in the second half of the New York session. Also, we can see that we tested the 0.85 level and bounced down off of that level, and that has been an important power line for the pair, as it had been resistance throughout late May and early June, and then had acted as support. But then now we've broken below that level and used it again as resistance. So to the downside, the Aussie can fall all the way down to 0.81 before it meets its next very strong support level. So that's pretty much the story right now. Commodity currencies are on the back foot because of concerns about global growth, but it's the euro gaining from all of this instead of the US dollar. Here we've jumped back to the euro-dollar pair. And so, as I said, it's the euro gaining instead of the US dollar, with the US's weak fundamentals and its prospect of low interest rates for the foreseeable future from the Fed, as well as weak yields on US Treasuries, is being pressured despite the overall theme of risk aversion in the markets. Therefore, if we see this new dynamic that is emerging this week, if it will continue in next week's trading, or that the more usual pattern of the dollar gaining on risk aversion returns. So that'll do it for today's recap. As a note, I will be going on vacation, so there will be no daily video recaps throughout next week, and I'll be coming back the following week. So till then, I want to thank you for watching and wish you good trading and a great weekend.